The Japanese yen's resilience, a tale of central bank decisions and market speculation. The Japanese yen is defying expectations as it continues to show strength against the US dollar, despite the odds. But what's driving this surprising performance? The answer lies in a mix of central bank policies, market speculation, and economic factors. The BoJ's rate hike dilemma. The Bank of Japan, BoJ, has been the center of attention, with its recent meeting minutes sparking speculation about a potential interest rate hike. The BoJ's cautious approach, outlined in its September meeting, considers inflation and trade risks. However, the bank's commitment to its 2% price stability target hints at a possible shift towards rate hikes. This has investors wondering, will the BoJ raise rates soon, or will it maintain its loose monetary policy? Market speculation and JPY support. Adding to the intrigue, Japan's Vice Finance Minister, Atsushi Nomura, suggested that the yen's recent moves are not solely based on fundamentals. Market speculation about Japan's fiscal policies has influenced JPY positions. This has led to a reduction in long positions, indicating a potential shift in market sentiment. A pro-stimulus prime minister, Japan's new Prime Minister Sanae Takaichi, favors aggressive fiscal spending to combat inflation and stimulate the economy. This pro-stimulus stance could impact the BoJ's decision-making, making it hesitant to commit to further rate hikes. But here's where it gets controversial. Some argue that this might limit the yen's upside potential, while others believe it could provide stability. USD's hawkish tilt. On the other side of the equation, the US dollar has been on a tear, supported by the Fed's hawkish stance. Reduced expectations of another rate cut in December and upbeat macro data have bolstered the USD. This has limited the downside for the USD-JPY pair, making it a key factor to watch. Economic data and uncertainty. The U.S. economy has shown resilience, with private sector employment rising and the ISM non-manufacturing PMI hitting an 8-month high. However, the longest government shutdown in U.S. history has clouded the economic outlook, leaving investors cautious. This uncertainty is holding back USD bulls, but for how long? And this is the part most people miss. The impact of this shutdown on the Fed's future decisions remains a crucial question. Technical analysis and dip buying opportunities. From a technical perspective, the USD-JPY pair faces resistance near the 154.40 to 154.45 region. A break above this level could trigger a rally towards 155.00 and beyond. Conversely, support around 153.65 and 153.00 to 152.95 could invite dip buying, with a potential rebound towards 155.60 to 155.65 and higher. The BoJ's monetary policy explained. The BoJ's mandate is to ensure price stability, targeting around 2% inflation. Its ultra-loose monetary policy, initiated in 2013, involved quantitative and qualitative easing, QQE. The bank's aggressive strategy led to a weaker yen, especially as other central banks tightened policies. However, the BoJ's decision to abandon this stance in 2024 reversed the trend, causing a partial recovery in the yen's value. The yen's journey and global factors. The yen's depreciation was further fueled by global energy price spikes and the BoJ's policy divergence with other central banks. This led to rising inflation in Japan, surpassing the BoJ's target. The potential for salary increases added to the inflationary pressure. In summary, the Japanese yen's performance is a complex interplay of central bank decisions, market speculation, and economic factors. As the BoJ navigates its rate hike dilemma and the Fed maintains its hawkish stance, the USD-JPY pair remains a focal point for traders. Will the yen's resilience continue, or will market forces eventually prevail? Share your thoughts and predictions in the comments below.